Welcome to the deep dive video update. This is a video that I do once a week in addition to the daily videos that I do and a weekly video and an inter-market analysis video. This video looks at different charts, some that are unique just to this video. Other charts are charts that sometimes we use and sometimes we don't, but we still want to keep an eye on those charts because they might be giving us some clues that aren't really blatant right now, but still can be helpful nonetheless. This is being prepared for Monday, June 3rd. Now, this video is going to be longer than the usual one if you've seen these before. Some of you are seeing videos that I post for the first time. On Monday, June 3rd, I am launching a program. And what I'm going to do on the next slide is I'm going to explain that program. It'll probably take me 10 or 15 minutes or so of the video to do that. That means this video will be longer. If you've already seen that and you know about the program, or if you're not interested in the program, if you're on YouTube, I will be putting a chapter mark at the end of my explanation here, and you can just skip ahead and go to the rest of the video. If you're on Rumble, I can't put chapters in videos when I post to Rumble. So I'll be putting in the comments the time mark when you can skip ahead if you want to bypass what I'm talking about here. What I have is called the SPXInvesting Program, and it's been around a long time, but it's taken a lot of changes and shifts. I've rebuilt the whole thing from the ground up. It's taken a number of years to do that, and I will be launching that on Monday, June 3rd. It will be a free membership for at least the month of June. Now, I may carry that over into July. We'll just have to see how things go. So if you want to go access that, check it out for a month. Just see the things that are there, because I go way beyond just the videos that I post on YouTube. Just see if this is something that is of interest to you. It's free. It'll only cost you your email address. And if you decide you don't want to do anything with the program, you can unsubscribe, and so you'll stop receiving emails from me. Once I do lock the program down and the site, everything's through Substack, it will be $97 a month. Now, some of you are like, oh my gosh, that's a lot of money. Others are like, man, that's next to nothing compared to what you provide. It's a relative thing. However, anybody who does become a member is automatically an affiliate. This means that you have a way of getting other people involved in the program. And if you get one person, for every month that they're in good standing, half of the $97 would be credited to you. If you get two people, then you have the full $97 per month credited to you. But you have to be careful with the kind of people that you're getting involved in the program. It's every month that those folks are remaining in good standing. So if they drop out of the program and you are counting on them paying half of your membership fee, that's not going to happen anymore. And I keep track of those things, and I'll be sure to let you know if those things change. But that's just a way that you can have access to the program. It's helping me because you are marketing and spreading the word about this. And you can even go beyond that. If you get two people, that covers your membership. You could get 10 people, and the other 8, that could be income that you could generate for yourself month after month after month, as long as the folks remain in good standing in the program itself. So just something to consider. So what do I include? The first thing is that starting Monday, actually it'll be for Tuesday's video because I already posted the daily video for Monday. The daily videos from this point forward will be locked down. They'll go public right when the market closes. So if I do a video for Tuesday, right when we have the close on Tuesday, I set a timer and it will jump over, change its status, so to speak, and it will become a publicly available video. The daily videos are the real foundation of the analysis and all the strategies and the courses that I teach and all of that. And so to me, that's the most important video of all. All these other videos, the one you're watching now, the intermarket analysis, the weekly videos, those are supplemental videos to me. Everything focuses in on the daily videos. And that's how that's my approach is every day go back and reevaluate. How do things look now? How do things look now? And we can often see things developing before they actually start to happen. And I found that to be a very effective way over the years. So that's one thing that you get added as a member. You will have access right when the videos are available. Then I do have a number of online courses. There's actually one additional course that I forgot to list on here. But there is right now what I call a basic course. This is if you don't know much about the markets or you just want to have a refresher. There's a course on YouTube and Rumble right now, but it's about 3 years old. Now, some of that information never changes. It was true 3 years ago and it's true now. But there are some charts and there's some examples and there's things that I talk about that were going on 3 years ago. Well, those things have changed. And I'm also changing the way I record those videos. Instead of spending all this extra time editing the videos, that's what was really holding things up. I'm just going with take one, like this video right now. I just hit the button, and as long as I don't screw up too much or nothing really loud happens, I just keep recording no matter what happens. But there will be an updated course for 2024 that's available. I also have a very lengthy and rather involved course dealing with technical analysis. That's another real foundation of the program, is figuring out what is the current condition of the market, what are the probabilities that we're going to go up, down, or sideways from here. And I break down all the things that you see in these charts. I go through those in the technical analysis course. Then I also have a class on strategies. Some of you just may use mutual funds. You may use ETFs, but there are some more advanced strategies where you can generate income. You can take advantage of different market climates, whether we're going up, down, or sideways. There are things that you can implement. It's not all about just buy low and sell high. You have different alternatives available to you. And then the next course, which is the final one listed here, I also do some training on software because there's different platforms that are available. But the fourth class listed here is mental analysis. This is coming to grips with fear and greed and trying to do things according to logic and probabilities and wisdom rather than just, oh, come on, baby, let's roll snake eyes here or something like that. Yeah, there's a real element of gambling in the market. We're trying to remove that and replace it with good, solid principles and a good, disciplined approach to how we do things. Then there will be a time when I take the courses that are listed here, 1, 2, 3, or 4, and I might take little bits and pieces, depending on what folks tell me, and then present that as a class. And it may be over a weekend. It might be a number of evenings. It might be Monday, Wednesday, Friday, Tuesday, Thursday, Saturday, whatever. We can go any way we want with this. And as a member, you'll be able to attend those courses, and there'll be more back and forth in these kinds of courses. When you're looking at the online courses now, they're all pre-recorded and it's just me. There's really no interaction because I'm talking to a screen the whole time. Well, in these live courses, there can be questions. There can be, can you explain that different? It's a little bit more like a live class. And you'll be able to attend those live courses, and there'll also be a recording of those classes that you can go back and watch. Then there's a community chat room that I've set up on Substack, and that'll pretty much be open all the time. It doesn't mean that I'm going to be there all the time, but you can go in and ask a question. Maybe, what about this? You can, something that you found out about, maybe an article that's interesting. You can post the link. It's just a way of being able to have some back and forth more in real time rather than dealing with comments on YouTube or Rumble. And for right now, I'll keep the idea of it being moderated in the back of my mind, but I'm going to try by not moderating it. We want to keep it civil. We want to keep it polite. We want to keep it in focus of what's going on in the program. And probably what's going to happen if somebody comes in and they're really rude and they're just not showing any proper manners or anything, they're just going to get booted out anyway. So I'm hoping I don't have to moderate it because I want to keep it to be a safe place. There's enough division in the world right now as it is. I want folks to know that when they come to this chat room, first of all, we're going to stay focused on what's going on with the stock market and the S&P 500 and the different strategies and so forth that we do. And all the other stuff that the world is dealing with right now, we're not really going to bring that in. Now, there are times when things happen and that may have an impact on the stock market itself. And of course, that's when we pay attention to things. But for the most part, it's not relevant to really what we're doing. So there's no reason to bring this up in the chat room. There will be some online posting. I may post something. You might have something that you found that you would like to post, a resource that you think other people might find helpful. And it'll be a chance for you to ask questions and get answers. You may not get all your answers from me. You might get it from another member. And we do want to try to keep whatever you post limited. I mean, if you got a long 10,000 word manifesto about what you think the meaning of life is, okay, we're not interested in that. We just want to keep it somewhat under control so that it doesn't get really out of hand. And I'm really going to stay on top of that a lot. And we also want to keep it relevant to the program. We might have a little bit of, what about those Seattle Mariners? What about the Oakland Raiders? Sports stuff, just common banter that goes back and forth for those folks that are actually interested in sports. But for the most part, we want to stay focused on what we're doing. And then there will be a time, and I don't know yet, it's going to depend on you folks, actually, the members. How often do you want to do this? I'm thinking of at least once a week and possibly more, where we get together and have a room either on Zoom or Rumble, or not Rumble, Skype, something like that, where we can all get together at a predetermined time and you can talk about, well, I did really well on this one, but this one just fell apart. What do I need to learn from that? Or this is what I'm thinking is going to happen in the market. What do you guys think about that? It's just a chance for folks to get together where I'm kind of the lead person because I set up the room, but other folks can have an opportunity to interject some ideas as that's happening. And we can set those up as needed. There might be times when the market is just going crazy and we're meeting every day. There might be other times when things are pretty slow, maybe the summer months or over the holidays, and we don't get together as often. And just it's there to use if we need to do that. And then there will be videos of live sessions. What I typically have done in the past is I would set up a blog and I would type out a pre-market open, because it's usually anywhere from 6 to 12 hours before the market opens when I get the daily video done for that day. Well, some things can happen. The Asian market's open, Europe opens. There's a whole world that's awake during that time while the US is sleeping, and things can happen. And we look at what are the futures doing, what economic reports came out, what are they saying, how's the market reacting to that? And I will typically do a pre-market open. It's like a blog post, but I'll probably do a video. And then if it's really an active day, I might post additional videos throughout the day, just do updates. And then if we're looking at getting in some positions, because the way I do things in the program is I guess you try. For me, it's written in stone. I never get into a new position that's directional. I wait until as close to the close as possible, and I only trade in the direction that I want the position to go. So if I'm looking to go long, which means I want to buy low and sell high, and I want to open a position to take advantage of that, I'm only going to open that position if the market's actually up that day. I'm not a dip buyer because things can change. We can have a down day and suddenly something that you were looking at, we end up having a down day, and now your plan might have changed. So I want to give everybody as much of a chance as possible to see as much of the day unfold. Well, about 15, 20, 25 minutes, 30 minutes before the market closes on those days, I'll open up a room. And if you want to jump in and we can talk about things, we can say, okay, you might say, well, I'm looking to get into this. And somebody else is like, I think I'm going to wait a little while. Somebody else might say, well, I closed out a position today. I mean, it's just a way for us to kind of work together, supporting each other, not telling each other what to do, but just kicking around ideas. And then there will be supplemental videos. I have a few on both Rumble and YouTube now, but there's a lot more that I want to do. I'm an educator. I like to do research. I develop my own curriculum, and I like to learn about things that have to do with the stock market, but are not necessarily part of the program. There's a thing called ESG. I would like to do at least one video, if not a number of videos. What does that mean? What does that mean for you as a stock market participant? What about the debate going back and forth between, are we going to go into a recession or are we not? Well, I can present both sides of that. I was going to do some videos like this and just put them out in the public, but you get people that are so dialed into their own opinions, and they're just vicious with, if you happen to say something that is a little bit different than what they've concluded. And I'm like, I don't want to go there. So this is something that I'm going to make available just to members. And it could be a book that I read, maybe an article that I ran across, a topic that I've been doing research on. And then there will be a sample portfolio plan. Now, when you go through the strategies course here, I talk about setting up a plan and different strategies. And some of these strategies will apply to you. Other strategies you'll never implement. It's all down to what you want to do. And then we have a sheet for each day that pretty much has all the information on one sheet. I call that a daily journal. And then based on what that sheet is saying, okay, what's the action for the next day? We always develop our strategy when the market is closed, when we're not in the heat of battle. And then I personally have very strict rules for when I get in, because if you get in right, most of the time, in fact, a high percentage of the time, if you enter a position right, the rest of it just takes care of itself. There are always some exceptions, but that's usually how I've seen it go over the years. And this will be a video that I put together, and you can go in and watch it. There'll also be a PDF that you can download, one that I filled out, but then I'll have a spreadsheet, I'll have a PDF. You can print it out if you'd like to. You can just do it right on your computer. You can change it however you want to maybe make it more the way you want it to be. Because the sheet that I have is more one size fits all. Well, if there are certain strategies that are listed on this sheet and you're never going to implement them, you can just wipe those out. It'll be Excel spreadsheet, and you can just save it as a PDF. So that's something else, so that we actually know before the market even opens, this is our plan for today. And this is what's going to need to happen for us to execute that plan. And if the things that don't happen for that plan, then we wait till the end of the day, we fall back, we regroup, we reanalyze things and say, okay, what's the plan for tomorrow? And then there is an email address here. If you want to talk to me about this, if you want to have a little back and forth, we could set up a time on Zoom or Skype or Messenger or something like that. If you want to ask about the program, that would be no problem. If you want to just keep it back and forth with email, we can send messages back and forth, whatever works best for you. Okay, so now I'm done with this part. So I'm going to put a timestamp here, and this is where I'm going to pick up doing the rest of the deep dive video. Okay, the first chart that we look at is a chart of the VIX, but you don't see the VIX on here. It's actually invisible. What I have plotted over top is a 50-period exponential moving average. This gives us a little bigger picture look at what is the general range of the VIX. And we don't really make decisions based on this, but typically when the market's under a lot of pressure and going down, that's when we get up into a higher range for the VIX. When things are looking a little bit better, that's when the VIX goes into a lower range. Then we had the whole COVID plunge and we went into a higher range. Now we're coming down. And since the latter part of 2023, we've been starting to develop a lower range as the market has been setting recent all-time highs. We also want to keep an eye on how fast is the VIX actually moving. Well, I use an RSI based on 9 periods here, and we're just about at the midpoint now. There was some time when we were going down pretty heavy there for a while, and we were going up pretty heavy, and we were actually getting an extreme reading here. The VIX goes opposite of stocks. So if the VIX is going down, that means stocks are going up. There are other times when we get to an extreme positive reading. And I only break out this chart and show it in the daily videos when we're actually getting some kind of an extreme reading. Here's another study of the VIX. There's the VIX itself, which is, you could also call it the fear gauge. When it's going up, that means there's a lot of fear. When it's going down, there's no fear or even complacency. Well, then there's another kind of calculation in addition to the VIX called the VVIX, or the VIX of the VIX. And I do a ratio between the two. And you look at this over a longer period of time, typically when this is going down, that means the VIX is going down, and that often means that the market's going up. Now, it's not always a hard and fast rule, and sometimes these get out of line with each other. But this just shows that we have been declining for most of 2024, but we're starting to tick back up just a little bit as the market had some problems back in April. And then the last week of May ended up being kind of negative, and kind of really shook the markets up. So we're seeing the VIX pick up just a little bit of steam right now with this ratio. So we just want to keep an eye on this. Then I do another study with the VIX. I take the VIX and how is it correlated to the S&P? Right now we're getting a rather low reading, so we're not using this chart. When we get up above this dashed line, that may be telling us that the market's getting really nervous at this point. And we may not be picking that up in the VIX itself and the other studies that we look at. So I keep an eye on this one. When we get up here, and you can see the red lines and how they corresponded with what the market was doing at that time. So I just keep an eye on this. When we get above the dashed line, then that's when I start showing it in the videos. Then we have the MOVE index on top, which measures the volatility of bonds. We have the VIX in the middle, which measures the volatility of stocks. I have a couple of different studies on here. The red line is just the S&P. The green line is the spread between the MOVE index and the VIX. What I watch the most is the correlation on the bottom. And they're having a pretty strong correlated relationship. Now, this isn't talking about stocks going up or down necessarily. This means are the volatility in bonds and the volatility in stocks, are they moving together or are they moving in opposite directions? And they're moving together, whether it's up or down. Then I've been watching this and I've been including it in the daily videos, and I even included it in the what to watch video. This is called the skew index, where the VIX calculates using at the money options. The skew index calculates by looking at out of the money options. And sometimes we see a pretty extreme reading here. We get up into this red area. Well, for a few days last week, we were up into this red area, and now we've dropped back down. So I'm including it here because we may come down, and this chart may become something that I don't show every day. But when we're up in this red area and then we drop from here, you can see I tried to mark at different times. We don't really know what that means. Sometimes it marked the top, sometimes it marked the bottom, sometimes it was just a continuation of what was already happening. But this can be really good to know, where we're not necessarily getting any additional insight from the VIX. We might get some additional insight from this chart. And we look at the ratio between the VIX and the MOVE index, stocks to bonds. And we were starting to show some improvement here, where this just means that the volatility of stocks was going down as this line goes down. Well, as we started to run into some problems, now we saw this ratio going back up. And if you look over the longer period, when this moving average, that's what I follow the most. When it's going down, most of the time, a lot of the time, the S&P is going up. And when this is going up, that's typically when the S&P is going down. So we can get kind of a long-term look at what's happening. We're starting to turn back up now because as of Friday's close on May 31st, we're kind of in between right now. The market could go either way. We staged a really nice comeback in Friday's session, and there may be some follow-through momentum to that. But we also spent a lot of the week underwater, and a lot of our other indicators are starting to turn negative, and that was producing more fear, both in bonds based on price and stocks. And so we started to see this go up. It came down in Friday's session, but the moving average is starting to turn back up. So we just want to keep an eye on that one. Then we look at a ratio between risk on and risk off. We look at high beta stocks versus the equal weight S&P. And there are times when we see this really moving one way or the other. But so far for most of 2024, we haven't really been seeing this. If anything, it's actually declining, where when the high beta stocks, these are the stocks that outperform in the market when we're going up. Unfortunately, they also outperform on the way down. They go down quicker, but we're not seeing an awful lot of choppiness. Actually, we are seeing choppiness. We're not seeing an awful lot of trending. If anything, we've been moving a little bit lower so far in 2024 as the market is getting just slightly more defensive. And we have a similar type of study. We look at the high beta again. These are the stocks that outperform either up or down, and versus low beta. And I created this chart thinking it would give us some real neat insight. Well, in 2024, it's not really moving all that much right now. So at least for the time being, it's been put in the deep dive video. If this thing really starts to move either up or down, then I'll start showing it in the daily videos. Then we keep an eye on where are we in relation to the previous all-time high that was set in early January 2022. We're 9.52% above the previous all-time high after Friday's close. And then Stock Charts does this thing called technical alerts. Here are the alerts for the whole week. When they're red, that's negative. When they're blue or green, that tends to be positive. Now I go through each day because this is Monday, or actually Tuesday through Friday this past week. And I break them down in the daily video. I don't spend a lot of time doing this. I just kind of glance over them. But if we're seeing an awful lot of red, that usually means the market's down. If we're seeing a lot of blue or green, that means the market's usually up. And you can see in Friday's session, we saw an awful lot of red, but then we saw this really, really solid bounce. But things didn't really improve from a technical alert standpoint here. So that's making us a little bit nervous right now. We want to see more follow through in Monday's session. Then Stock Charts also has this thing. You can use this for a stock. You can use it for a sector. I use it for indexes where they try to remove as much emotion as possible. And that's what I do in my program. Is I want to, if you look at a chart, I don't want it to where 8 different people can interpret it 8 different ways. I want everybody to be able to interpret it the same way. It's either positive or negative. And that's what I teach in my classes, or how to interpret those charts in an unemotional way. But still, there are emotions that we have to deal with in the market. Well, Stock Charts tries to remove that by just looking at a chart and then scoring it from 0 to 100. The higher the score, the better looking the chart. There are 5 main indexes that I will look at here. We look at the S&P. That's the foundation of what I do. The Dow, the NASDAQ 100, the mid caps and the small caps. And then we just rank them on a score of 0 to 100. Coming in first place, which has been more the leader since we've come up out of the lows in October 2022, and then the lows back in October 2023, the highest, or the best looking chart right now are the QQQs, which is the NASDAQ 100, coming in at 83.8. Not really strong. When this gets up into the 90s, that means we're really moving up with a vengeance. In second place are the S&P, the ETF for the S&P 500, coming in at 82.6. Now, there's 100 stocks in the NASDAQ 100. There's a few over 500 stocks in the S&P. The NASDAQ 100 is more growth oriented. So when we're really moving up, it tends to outperform. When we're under pressure, then we see the S&P. It may be going down, but it's probably going down less than the NASDAQ 100. It's coming in at 82.6. Then we've seen a bit of an improvement here. These are the small caps, and they've been a real frustrating area in 2024. They're coming in third place at 66.2. Then we had the mid caps, which for a while, especially after January, the mid caps would go a number of weeks and be the strongest index that we were following. We're seeing some weakness in this area right now. They're coming in fourth place at 77.9. And then in last place this week is the Dow, as represented by the diamonds, the ETF for the Dow Jones. And they're coming in at 37.4. And there's only 30 stocks that make up the Dow. So as earnings are coming out, if the Dow really gets hit, it can take the whole Dow down with it. And we've been seeing that under pressure lately. Then I look at some short-term charts. This is a short-term rainbow. This is made up of simple moving averages going from 10 periods up to 50 periods. And we did come down into the rainbow. We haven't quite cleared back up the rainbow over here on the right, but we did show an improvement during Friday's session. And we just look at this more in the big picture, saying that, okay, we had some problems in April and we were coming up out of that. We've been pulling back this past week, but we're getting up closer to the higher end of this rainbow right now. And we look at some short-term indicators. Now, if you give the market a couple of days to really get moving one way or the other, you're going to see these charts pretty much every day in the daily videos. But we've been chopping around quite a bit lately. And this is one of our shorter term indicators. This is the Williams percent R. And this can get extreme positive or negative very quickly. That's why I use it as a short term indicator. Then we have another indicator called the Stoch RSI. It tries to take stochastics and the RSI, a couple of momentum oscillators, and put them together. This is also very touchy, and it can stay extreme positive or negative. It's just coming off of being extreme negative. But since we're more in the neutral area, I went ahead and included it in this video. And then another shorter term indicator is called the Commodity Channel Index. I know we deal with stocks, but this is an indicator that also works well with stocks. It's the CCI based on 20 periods, and we're neutral right now. And then we have a little shorter term, the CCI 14, where it is negative, but we haven't quite gone extreme negative yet. And these indicators, in addition to some others, are what I focus on in the short term. This is also short term, even though it starts off with a 20 period moving average, that is short term. 50 is intermediate, and then a 200 period moving average. This is called a boom indicator. And when we're above or below one of these moving averages and we get too far away from it, we have a tendency to boom, go back to that particular moving average. So when we set it up like this down below, we can use this like an oscillator when it can give us an extreme positive or negative reading. We're at about the middle right now. So, and I include this in the short term because we hit that first. And then after that would be intermediate term and then long term here. Then some intermediate term charts. This is another rainbow, but I switched the moving averages around to go from 50 periods up to 100 periods. Even though we came down this past week and bounced up from that on Friday, we never came down into the rainbow itself. So the intermediate term trend, and that's where we bounced off of. We didn't quite hit the 50-day moving average in Friday's session. It was about at the 5,200 level for the S&P, and we just found some really solid upward movement from that. A lot of buying came in. We are keeping an eye on the 100 period moving averages. We're still well above them. We're really watching the 20 and the 50s right now. And unless we see more follow through weakness, I won't be showing this chart. And this is another momentum oscillator called the Connors RSI. And it jumps around quite a bit day in and day out. When I use this is when we get an extreme positive or negative reading, and then we use that to confirm with some other oscillators to see if they're giving us extreme readings at the same time. The CMB composite, when we were really moving up in May, this was extreme positive for many days. Well, since that time, it's really dropped back down, and it's not giving us any kind of an extreme positive or negative reading right now. So I haven't been showing this chart. Then Bollinger Bands. Now there's books written about how you can use Bollinger Bands in many different ways. There's one application that I use here, and this is called the percent B indicator. It's when we close either above or below one of the Bollinger Bands. If you look at other times when this happened, we have a tendency to have that happen not very often, and when it does, it usually doesn't last very long. So we want to know when that's actually occurring. We're not seeing an extreme reading right now, so there's been no need to include this chart. We also look at point and figure charts. We didn't see any new X's or O's drawn in. X's are when we're going up, O's are when we're going down. We're still working off of a signal that was generated on May 15th, which is a positive signal. You can see where it's green here. That's a double top breakout. And until the market proves otherwise, the point and figure chart is still on a buy signal. We look at anchored moving averages, but we're so far above this anchored moving average going back to the previous all-time high. I haven't been including this chart. I was playing around with this, trying to come up with some different anchored moving averages. And these are really only helpful now since we're just coming off of setting all-time highs. They would only be helpful if if we start going down. So if we see a real decline in the market, then I'll probably add some more anchored moving averages. Now, an anchored moving average is different than a regular moving average. If you have a 10 period moving average, that takes the price right now and then calculates the last 10 periods to come up with its current value. An anchored moving average, you can put back to some kind of previous high or low, and then it extends forward from there. So it's a little different application. We want to know how far above or below are we from the 200-day simple moving average. We're still up over 10.5% above the 200-day average. So that just means the long-term trend is still intact. We measure standard deviation. This does not measure direction. This measures speed. And we've dropped down below the moving average. So that means we've slowed down because we were just really screaming up as the market was going higher. And we have to use other charts to tell us the direction. This just says, oh boy, things are moving fast, and it could be either up or down. Then we keep an eye on the S&P 100, which are the biggest stocks that make up the S&P 500. And it's been doing well as some of the other bigger stocks, the mega caps and the Magnificent Seven or the Dynamic Duo or whatever it's being reduced to now or added to. Those stocks are also included in the S&P 100. And so when we're in a more positive environment, we want to see the S&P 100 actually outperforming the S&P 500. And when we're running into more difficulties, that's when we see the S&P 100 actually underperform. But that's other charts that I use in other videos. What we're looking for here, any kind of real divergences from each other. we're not really seeing them. They're actually confirming each other at the present time. And we do some measurements. This was the low. Well, here's the low set back in 2022. Here's the low that we set in October 2023. And since that time, we've been bouncing up. We hit a new all-time high, came back. Now we set some new all-time highs before seeing some more weakness. And according to this measurement, we're up 22.13% from the October 2023 low. This is more just for information. The mass index, I was really following this because it triggered a signal a couple of weeks ago. And it may have been trying to warn us about this decline that we've seen, but the decline really didn't start until this signal was about a week old. And that's too long, in my opinion. So I stopped using this, and now it's giving us a very low reading. When it gets up around the red dashed line and the blue line, that's when a signal is generated. And right now we're far away. Pring bottom fisher. It had generated a pretty good signal back in late April, and there was a little bit of hiccup along the way, but it really led us higher. Well, we crossed below here, and so that signal is pretty much gone. It doesn't mean that we've turned negative. This really just tries to give buy signals, not so much sell signals. And then the Ichimoku cloud. This is an area of support when we're up and we pull back. This can be an area of resistance when we're going down and we bounce back up a little bit. We're far above the cloud right now, so there's been no need to show this. Now, I added what's called a full study here, where in addition to the cloud, I made it a shorter term chart, and we also follow the blue line and the red line. When the blue line's above the red line, that's an uptrend. And even though we've been pulling back, the blue line is still above the red line. Then a little bit longer term, we have the green line here, and that's still going up as well. So even with the weakness that we've seen, this indicator is suggesting that things are still okay for the time being. A long-term rainbow goes from 50 periods up to 250 periods. We came right down to the top of this rainbow, and we were able to bounce up off of that. And we can see that the long-term trend is still intact for the present time. We look at a special K chart. We don't get very many signals from this chart, so I only show it when we're actually seeing a crossover between the black and the red line. We crossed over back in 2023 in November, and so there's been no need to show this since no new signals have been generated. And we have a weekly chart of the S&P on top, a weekly chart of the German DAX. They're the biggest stock market in the EU, and we see that there's a pretty strong correlated relationship between them currently. So it doesn't mean they're going up or down. This just means that they're tending to go up or down together at the same time. And then this is kind of a funky study I ran across a while back. We take the 10-year yield and we subtract the German 10-year yield, and that gives us the result here. And since US rates are higher, that means we have an answer above zero. And then for some silly reason, we plot, well, that's not silly, but the logic behind this seems kind of silly. The US dollar index we plot down here, and then we look at the correlation between the top chart and the middle chart, and we can see that they're actually going in the same general direction right now. There are times when they actually go in opposite directions, but keeping an eye on interest rates, that's having a real impact on the dollar, and that relationship is pretty much intact right now. But I typically use this more for information. I don't make decisions based on this. Then we have some support and resistance. I did readjust the Fibonacci retracement levels back to this all-time high that was set for the S&P, and we're far above this 38.2% retracement level, so there's been no need to show that. And then we look at a thing called the Vixen. Gotta love that name. We have the VIX, which measures the volatility of the S&P 500. The Vixen, it measures the volatility of the NASDAQ 100, and I mainly focus on the line chart down below here. And then we have the banks. We want to keep an eye on that. A lot of banks were anticipating that interest rates were going to be cut in 2024, and that's in doubt right now. And even if it does happen, it looks like September would be the earliest for that to occur. So we want to keep an eye on this area. They are in an uptrend. The financial sector so far has been holding up, but we just want to be aware that things could change. It was a year ago that we saw Silicon Valley Bank and Republic Bank. It was a few months ago that we had New York Community Bank. A lot of these smaller regional banks were really counting on rates being cut in 2024, and they're having to roll over some debt, and they have some bonds, and this could really have an impact on them. And we're just waiting to see if that's going to become an issue. Then this is a ratio between the regional banking ETF and the financial sector. And we were doing okay, but then this is when Silicon Valley Bank and Republic Bank had lots of problems. Then it's like, okay, maybe we're stabilizing a little bit. And then here's where New York Community Bank came out with their news. And we've been not doing so well ever since then. We look at the S&P on top and then a ratio between the Qs and the diamonds, and we see that they're really having a tendency to go in opposite directions now. And some of this could be blamed on the Dow, because even in Friday's session, it was still under pressure. And the Qs have been under pressure. They bounced from being extremely negative to getting back to unchanged, which may not seem like that big of a deal, but being down so much and getting almost back to break even was really kind of positive. We keep an eye on the transports, and this has been a real disappointing area. The red line are the transports, the black line is the Dow. In a more healthy environment, we want to see the red line outperforming the black line, even though they're on different scales here. We look at a ratio between the Russell 1000, which are large caps, and that could be similar to the S&P 500, and then the Russell 2000, which are small caps. And this gradually going up over a period of time just means the large caps continue to outperform. If this really starts to go down, that means the small caps are seeing more favor. And then I debated whether to use this in the daily video or not. If we continue to look more negative here, I will. But this is a broad market measure across the Amex, NASDAQ, and NYSE. We take a 5-period moving average of the highs minus the lows. We've been above zero for pretty much all of 2024. We did dip down here for a while, but now we've been coming back up. But we're getting close to the zero level right now. If we drop negative, then I'll start showing this chart in the videos again. As long as we stay positive and look to see some strength here, then I probably won't show this. And that's just showing that there's more broad market strength right now. Then a couple of rate of change charts. I have a ton of rate of change charts, but these are only for this video. This is going back 250 periods to see that even though we've been declining a little bit, the longer term trend is still up. And we came up to this blue line. This is another look going back to 1980. And we hit a little bit of overhead resistance, and we've been pulling back since that time. But still, when you take a bigger look at this, we're still in an uptrend. We keep an eye on bonds. I've been showing a lot of ratios between stocks and bonds as we've been going through some difficulties over the last few weeks. This is a chart that also does that ratio, but the movement isn't as pronounced. This is TIPS, which are Treasury inflation protected securities. And these are what folks get into when they think that inflation is a problem and interest rates are going to go up, because they adjust in the shorter term. Well, then when we think rates have topped out and we get out of the TIPS and we jump into either 3 to 7 year bonds, 7 to 10 year bonds, or even 30-year bonds, and then this ratio starts to come down. And that's what it was doing there for a while. Well, now it's starting to go back up. But we look at another ratio that it's moving a lot more right now. This one appears kind of tame compared to what we're seeing between TIPS and the 7 to 10 year. So I just dropped using this chart. We're also seeing where this ratio is seeing a recent golden cross. That means that the TIPS, the inflation worries, are actually in an uptrend when compared to the part of the market that wants inflation to be more under control. Then we look at the TLT for the long-term bond, that's in blue, and the S&P, that's in red. We look at the longer-term correlation based on 50 periods, and it's fairly strong. They're moving more in tandem with each other. And then we look at a shorter-term correlation where it had dropped off slightly, but the shorter-term correlation is starting to get a bit stronger. And then we look at the Qs to the TLT, and then the correlation between the two. So this is the NASDAQ 100 to the long-term bond ETF. They're having a pretty strong correlated relationship. Doesn't mean they're going up or down. It just means they're tending to move in the same direction at the same time. And then here's this chart again. Isn't that nice that I included it? We also keep an eye on the different yield curves, where we're still inverted with the 10 to the 2-year and the 10 to the 3-month. We've been that way now for a couple of years, and I say that in every daily video, but we're just waiting to see when we're going to finally go back to being normal. And then I have a number of things called possible positive scenarios. When we're in a more negative climate, there's a number of charts that I look at that suggest, okay, maybe we've gone down enough and we could be looking at a bottom that we can bounce up out of. Well, some of those charts I use every day. The other charts that I have that I don't use every day are included here. This is a 200 period moving average study of those stocks inside the S&P. And I use this one like an oscillator. When we're getting an extreme positive or negative reading, we're not getting that now. We are more positive right now with this chart because we're above 50, the green line. That just means there's more stocks above their 200-day moving average than are below. Then I take that same basic concept and I go based on the 50-period moving average, also using it like an oscillator and just barely crossing back above 50. Just to get a bigger picture, we also look at the mid caps, which are finally coming back above 50. And then the small caps, which are also coming back above 50, but we're not seeing any extreme readings currently. And then we keep an eye on the S&P on top and then the 2-year yield. Sometimes when this really spikes up and then comes down, that can give short to intermediate term support to the S&P, but we're not really seeing that right now. Thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. I hope you're having a great weekend, and I will talk to you in the next video.